Did anything we hear from the Fed and from Powell today change the calculus for banks?
That's a very good question. I don't think so at all. I don't think there was, this was a historic announcement by Chairman Powell, but on the other hand, there's really nothing new, Kayleigh. It's really very consistent with exactly how the Fed has been behaving through the pandemic in terms of hyper-focus on getting employment back, very relaxed, if I can use that term, that some inflation could be positive. I mean, you even hark back to 2012 when Bernanke first set an inflation target. That was the first time of 2%, which was probably a recognition then that some inflation would be okay post the financial crisis and as the economic recovery began to falter a bit. And of course, all of that from the days of the early 80s and Paul Volcker and at that time, the danger of high inflation. So I am not surprised. I think this is a codification of exactly the policy that we've been seeing implemented by the Fed. And I think certainly for the near term, I don't think it changes a lot the challenges that the big banks and the national banks have, which really comes around with very, very low interest rates. It's, for quite a bit of time as we look out. Where is the net interest margin going? In the second quarter for U.S. banks, it was an all-time low. With all the challenges in the economy, where are loan loss provisions going? For the U.S. banks, can we repeat the trading environment of the second quarter? Unlikely. For many banks that are not in the U.S., they don't really even have those trading operations. So I would say for the European and U.K. banks, it's going to continue to be an extremely challenging period in which to find earnings. The banks are safe. I think the capital levels remain high. But the key question here is where are the earnings coming from in this environment?
Bob, let's talk a little bit about the shape of the curve. Do you think the curve stays incredibly flat? I'm judging by what you just said that you probably do. Do you not expect this focus on an inflation overshoot at some point to be priced into the market with a steeper curve? And presumably that would have a positive impact on the net interest margin.
Yes, and it may, but I think that the key on the net interest margin, Guy, is very, very much that short rates are going to stay very, very low. I think the Fed would like to see a bit of a whiff of inflation. I don't think it's certain that they're going to see that, but I think they'd like to see a whiff of inflation, and certainly that would have an impact. If we saw any of that, we'd certainly see a reaction to the curve. But until then, I don't think it's going to have a big impact on the net interest margin. It's really the short end of the curve that matters on that.
Bob, what about elsewhere in the market? Is the Fed supporting asset bubbles in your view?
I think the Fed's focus, I mean, it was so crystal clear today, to me it was crystal clear, Kayleigh, which is their number one priority is to get employment back. And I think they prioritized, in the way I looked at this, they probably prioritized employment even more than it's okay to have an average of 2% inflation. And I think in the past, the Fed has always acted to offset employment levels going above or below what they consider to be full employment, which has always been recently been about 4%, or I think technically 4.1%. They're getting away from that, and now they're going to address any shortfalls to full employment, which means that, even when employment prior to the pandemic fell below full employment, we didn't have inflation. So, again, I think what this says is that they're welcoming a bit of inflation. To your question of asset bubbles, we're talking today in our morning meeting here in New York. We're sitting here a year ago looking at 2020. And we were shocked to see that the projections for 2020 meant that the United States, for the first time in its history, might have a budget deficit above $1 trillion. Well, today we're looking at a budget deficit above $4 trillion with over $3 trillion in stimulus coming. So are there possibilities of that with easing monetary policy and all the other things that we're seeing? Certainly there are possibilities of that.